We think that active investment is the best way of investing in emerging markets. The reason is unlike the US and developed markets, emerging markets are very differentiated countries. They have different cycles, and different political regimes, and very different industries. And so that means that by being an active investor as opposed to being passive or smart beta, we can use the opportunities in countries, in stocks, and also in industries, and also changing the beta to generate returns. We look at emerging markets in three broad buckets. The first are domestic focused markets like India and China, with good growth potential, but very much driven by domestic factors. Then we have the more globally driven markets like Korea and Taiwan, which are much more influenced by global sector trends, particularly in technology and the supply chain. And then there's what I would call the traditional emerging markets, ones that are driven by US macro, as in level of interest rates in the US, the level of the US dollar. Obviously, you've still got to think about the geopolitical risk in the country and growth rates, but they are the main drivers. Yeah, let's firstly take stock picking. So, as active investors, knowing our companies well, we can go overweight some companies that we really like and we think the reward risk is very favourable, and we can underweight or avoid others. And secondly, on a country basis, we can differentiate between countries. We use a disciplined formula of earnings growth, valuations, currency returns, dividend policy to differentiate at country level. Why is this? Because many countries have different macro outlooks, they're in different cycles, they have different risks, so it provides great opportunities. One of the best opportunities in active investing relative to passive is to be able to control our risk exposure, to dial up the risk when conditions are favourable based on our investment process, and then to be a bit more cautious when conditions aren't so good. And that really enables us to get a very good balance. As a passive investor, you can't do this. And then one really important point for emerging markets is indexes are quite backward looking, and there are always new countries coming into emerging markets, and we have the ability to invest in these before they come into the markets. So active risk is embedded in our portfolio construction process. We measure how we dial up the risk, we dial down the risk. So effectively, when we've got a higher reward risk ratio, we have more risk in it. When that reward ratio goes down, when we take less risk in it. So we believe that we can add value in stock selection. Stock selection involves fundamental analysis. But on top of that, the one thing that we think adds a lot of value is by engaging with companies, meeting the management, understanding them. And that gives us more confidence to go more underweight or more overweight a stock. So one of the most important points about fundamental analysis, how we decide to choose which company to buy, we spend a lot of time on the ground in emerging markets, meeting the management, understanding the companies, understanding their rivals, understanding the opportunities and the threats. In passive, you can't do that. You just buy the index weighting.